I've been doing quite a bit of traveling over the last month, and I haven't really been looking too closely at my portfolio during that time, and that's probably for the better because last month was pretty ugly, but really it's been a pretty ugly last year for most stock investors if you're looking to see your portfolio go up in the meantime. Of course, if you're looking to buy, then you could say that this is a great time because the companies that you might have liked at higher prices a year ago are now much cheaper, so you could make a pretty strong argument that that is a great thing, but still it is psychologically very exhausting to see the money that you put into the market, the money that you've worked hard for, you watch it just kind of get wiped away. Of course, it could come back just as easily, theoretically, but it's pretty exhausting nonetheless. But let's go ahead and get through the pain real quick, and I'll tell you about what I did with my portfolio, really more like what I did outside of it, using this portfolio as leverage. I'll get back to that, but first let's, again, rip the Band-Aid off. We're down, about 2% on the day. About 4% on the week. That's $3,000 gone. Paper wealth, of course, it's not real until you sell, but it feels real nonetheless. In the last month, we're down about 5%. In the last quarter, we're down about almost 20%, 19% we'll call it, down nearly $18,000. And in the last year, we're down almost $25,000 at a 30% money-weighted negative return. And if we go to the all-time, it's not quite as bad, only down about $16,000. So pretty significant losses on paper. Again, a lot of the money that I've put into this account has come really in the last 6 months or so. They're really approaching the last year or so. If you look at the all-time view, it's a little bit skewed because a lot of this money came pretty recently. But regardless, it's a lot of paper wealth that is now gone. But hey, it is just on paper.
On paper.
Switching back to the 1 month view, if we go ahead and look at my holdings, there are some holdings in here that I really would like to add to, but just haven't been able to put a ton of cash towards because I'm very busy buying a house right now. I actually just closed on the house and we're rehabbing the house. That's where a lot of the new cash that's coming in is going. Pretty much all of it is going towards that. And I'm actually taking out some debt to do it too, but I'm getting ahead of myself. That's a big thing that this portfolio is used for. But just taking a look at some of the holdings that are really at the top of my watch list right now. One of those is Sleep Number. They have pretty significant cash flow, not a ton of cash. They do a lot of buybacks. They have a pretty significant debt load. They use debt to finance their buybacks, which is generally a red flag, but it has worked in the past, I suppose, and they've been able to get by because they have such high cash flow. But there's some serious concern that cash flows in general are going to be decreasing. So there's been a lot of negative movement over the last few months with Sleep Number, along with many different stocks in the broader market. But that's one that's at the very top of my list right now. I would like to build out this position to be a much larger one relative to the rest of the portfolio. And then also at the same time, I'm looking to add to Facebook, now called Meta, which it has officially changed its stock ticker to Meta. That did that, I think, last month. But I would like to add more to this as well. Its stock price has been kind of fluctuating around this 160 mark, which is pretty comfortably into my buy range. Of course, I'd like to get it lower, but we'll see what the market does. Pretty much under 200 is when I really started buying in earnest, definitely under 180. And I've brought this kind of average share price down quite a bit, under 200 now. And I would be looking to add more to this as well. So Sleep Number and Facebook at the moment, or Meta, are really my top two targets, though I would be interested in adding to my other holdings as well. Just I don't have a ton of cash coming in at the moment, at least not as much as I might normally have, because like I said, we're buying a house, which brings me to the main topic of this video, and that's that I borrowed about $16,000 against this portfolio using M1 Borrow at a nice 3.5% interest rate. That is a variable rate that I'll say probably will go up if the Fed does what the market thinks it's going to do and raise rates again. So this rate would go up too if that were to happen. But regardless, right now it's only at 3.5%, which is still really low when you consider that inflation's sitting at a nice 9%, at least based on the government's metrics. So it's super high inflation, much higher than the current rate. So it's still well below the inflation rate. And frankly, if 1% interest is the make or break for your entire financial picture, you're probably very over leveraged. And I'm not at that point yet, I would think, but I do have quite a bit of debt and I'm trying to be careful with that. Check out the net worth series if you're interested in seeing the whole financial picture that I have. I show my stock portfolio, show my real estate holdings and everything in broader context. This is just a large portion of my taxable stock portfolio. It doesn't show everything else beyond that. And I think it provides some useful context And that's very important for this because I took out the $16,000 not to invest into the stock portfolio, but rather to buy a piece of real estate. This basically covered my down payment. I bought a house in Houston that we're officially closed on. It's all good to go. And now we're underway with the rehab. It's going to be very expensive rehab, probably well over $70,000 at this point if we're going to do what we think we're going to do. And we're already at probably 15 grand into it. So a lot of cash is going towards that. It's going to be significant rehab. And like I said, we're already underway, so we're taking out cash. And I probably wouldn't use any more margin than this for a while since we have our HELOC debt that we can tap into as well. That's also at a rate right around here as well, right around that 3.5% rate. So it's not like you're getting a huge advantage here. And this does open me up to a potential margin call. That would happen if my stock portfolio fell. And that's kind of what this sort of 66% good rating is, in that I have sort of a 66% cushion. That is, if my account value drops by 66%, then I would get a margin call, or they call it a maintenance call, in that I have to pay the debt right away because they are collateralizing this debt to my stocks. So that's always a risk you run with margin, in that you could get margin called and they could force you to liquidate your holdings to pay back the debt. Right now, this stock portfolio is right around $80,000 in market value. So we would really need some pretty serious pain if I were to reach a margin call with only $16,000 in margin. And that is significant money. It's $16,000. That's $16,000. And it's a significant portion of the portfolio, but it's not really that close to margin call territory unless we had just a massive, massive crash from already depressed prices from a few months ago. Granted, you could still make a pretty sound argument that the market is still quite expensive when you look at underlying fundamentals. So it could always go down is really all I'm trying to say. But this is not the first time I've done something like this. If we actually go back to sort of my history of borrowing against this portfolio, we can see that I did something like this back in July of last year. This is when I was buying my previous home, the one I'm filming from right now, that I'm going to be moving out of soon and turning into a rental. This effectively covered the down payment for that home. So I did almost the exact same thing here. Then I proceeded to pay it back over the next couple of months. And that's what I would be looking to do as well with this one. It might take a little bit longer because we're still paying a lot towards the rehab budget. So that's going to take a lot of cash that might otherwise go towards the margin pay down. But that would be the plan, to pay it back over, we'll say, the next quarter or two, and it will get paid back down to zero. I don't intend to hold margin for the long term. I use it as a short-term tool. Partly because of that variable interest rate, you are potentially exposed to higher interest rate costs, which in a rising rate environment is an especially bigger concern. And then, of course, you have that margin call risk. So it's always just a little bit risky to have at any level. And the greater this sort of debt gets, the bigger that risk is. So I do want to pay this down pretty quickly compared to maybe some other debts. But this is how I can turn my stocks into a savings account effectively, in that I can pull money out without actually selling. However, of course, you have the volatility that comes with holding stocks, and that I could watch $3,000 over a week vaporize. And there goes your potential purchasing power if you were trying to use this money to make some sort of purchase. You can't leverage that now because it's gone. You can't sell it now because it's gone. So you run that risk when you invest, in that there's volatility in the price movements. You have the market to worry about. You have the individual holdings to worry about. So there's a lot to worry about when you're investing, and you need that money in the short term. So this is sort of I don't want to call it a compromise, but it's my way of maintaining liquidity in the portfolio to invest in other things while still remaining fully invested. But then you run the biggest risk here, in that I don't have a lot of cash outside of pulling more debt out to keep investing in stocks. So I have less ability to jump on the opportunities that I mentioned earlier, like Sleep Number or Meta or any stocks. I don't have that extra cash sitting on the side to invest because I'm already fully invested. I'm not too worried about that because I think the sort of losses I would face at an account value of this size really aren't that big. The opportunity cost losses, that is, because it's really not that big of a portfolio in the grand scheme of things. Yes, $80,000 is a lot of money, but I want to get this portfolio to a much bigger level, and that's going to happen over years. And I'm just trying to get as much money into the market as possible, not being tempted to spend that cash on something else. I'd rather just build up this portfolio to where the swings in it might actually make a serious difference in my life. But then again, if that was the case, my portfolio would be quite large, and then it's probably throwing off a good amount of income via dividends perhaps, or I'm bringing in money elsewhere in that I'm using this as collateral to invest in cash flow assets like a rental property or some other business or something like that. So if I get to that level, I should be in good shape is really all I'm trying to say. And if it means I miss out on the occasional buying opportunity, I'm okay with that. That's the risk I'm taking by remaining fully invested and instead using leverage to try and create those outsized returns in other ways. I'm not suggesting that you do that because there are plenty of risks associated with that. And I don't know what your risk tolerance is. So you really have to figure out what you can stomach and what's comfortable for you and what your overarching financial goals are. They might be different than my own. So please do your own research. Don't just copy anyone because they told you to. Do what is right for you and your portfolio because everyone is different. But do tread carefully, of course. And if you're looking for a stock brokerage to get started or even to supplement your existing portfolio, definitely check out M1 Finance. That's this platform I'm using right here. I always include an affiliate link in the description below. It's free to open an account and it's got a really nice interface, especially for kind of long-term investors. It shows you your target allocations in a nice, easy to follow way. You can create these things called pies, so you can see kind of subsections of your portfolio and you can alter them through time as well. So it's just a nice platform for the interface side. But then of course you have some nice tools like auto investing. I don't use that since I'm picking individual stocks, but if you're an index investor, I think this could be a really nice tool if you're just trying to invest consistently every single week or month or even every day, I suppose. You could really spread it out that way and it's all automatic and it tries to fit your target allocations that you set here. And then of course you have the nice borrow feature that I just showed and that you get some really cheap margin in the grand scheme of things if you do the M1 Plus account, which does come with a membership fee. So if you want to get the best rate, you do have to pay an annual fee. And if your account balance is big enough, this can definitely make sense. It makes sense for me since I'm actually using margin at least on occasion and I want to have access to that good rate. And you also get an extra buying window. One of the drawbacks with M1 Finance is that you can't make purchases at just any time. You can only make them at 2 times per day if you have M1 Plus. Otherwise, it's only 1 time per day. You have the 8:30 a.m. Central Time window or the 2 p.m. Central Time window, which is definitely the biggest drawback, I'd say, in that you can't actually make purchases at any time. It's only during windows. But hey, if you're a long-term investor and you have a pretty specific buy target, it shouldn't be too hard to get a stock at a price that you want, but things are very volatile. So sometimes speed really does matter when you have sometimes 10% swings on a stock during a single day, which we're seeing seemingly all of the time, especially in this very volatile stock market season. If you end up funding your account, I might get a commission and that will go a long way towards helping the channel. So do please check it out. But with that said, if you guys like this video, please like, comment, subscribe, all that great stuff. And until next time, take care.